Right friends, welcome back to this banking awareness lecture, module number 8, a snapshot on banking operations. In the last lecture, we discussed about two types of negotiable instruments. One is bill of exchange and the second one is promissory note. And in this lecture, we are going to discuss in detail about the checks, what is the various nomenclature associated with the checks, properties of checks, what is meant by bouncing of a check, then demand draft, and what is the meaning of CTS 2010 checks, right. So, let us look at what is meant by check. So, let us look at the definition. Some of you may or may not understand. As the definition goes, it is the unconditional order in writing drawn by a customer of a bank requesting the bank to pay specified amount to the payee, right. So, in this PPT you are looking into the specimen copy of the check, definition of check and various features of the check, that means rules and regulations or the properties of the check. And before understanding what is meant by drawer, drawee, payee, I would like to take up with one example, right. So, let us look at this illustration, left side and right side. Left side is check issued to a friend, right side is self check, right. Let us look at a customer X, he is a native of Delhi. Customer X is a native of Delhi and his bank is State Bank of India, Delhi. His bank branch is State Bank of India, Delhi. He is issuing a check for rupees 1 lakh to his friend in Chennai. His friend Y is staying in Chennai and X has given check to Y for a value of rupees 1 lakh. X branch is Delhi SBI and Y branch is Chennai SBI. Here, when the check is given by X to Y, Y will present the check in his branch at Chennai. Y will present the check in his branch Chennai. So, here the drawer or maker of the check is X. X means whoever is giving the check, he is the drawer or maker of the check. And drawer's branch is drawee branch. Here X is drawer, his branch SBI Delhi is drawee branch and his friend Y in Chennai is payee, drawer, drawee, payee, right. And do not confuse, the branch of SBI at Chennai is not a drawee branch. The drawee branch is the branch of the drawer. The drawer of the check is X. X is giving 1 lakh rupees to Y. The drawer of the check is X. His branch is a drawee branch and payee is Y, his friend in Chennai. So, this is three parties are involved when the check is issued to his friend. When the check is issued to friend, three parties are involved, drawer, drawee and payee. Payee will present the check in Chennai branch and Chennai branch will make arrangements for cross-checking the details with the Delhi branch. After verifying the details written in the check, written over the check with the Delhi branch, then the payment will be made to Y at Chennai, right. And this is about the system when check is given to his friend. Let us look at a situation when we are withdrawing money by going to the bank. That is known as self-check. So far I have discussed about left hand side illustration. Let us look at the illustration towards the right hand side. Here the illustration is self-check. I am withdrawing 1 lakh rupees by going to the bank. X is the person in Delhi, he is going to his branch SBI Delhi to withdraw 1 lakh rupees. Here the drawer is X, drawee is SBI Delhi and payee is also drawer because he himself is withdrawing. So, when the self check is presented, there are only two parties, drawer, drawee, payee will be the drawer himself. When you are presenting self check to the bank, you will be drawer and payee and the bank will be drawee, please don't forget. So, three parties are involved when the check is presented to the third party, and when the self check is presented to the bank, it involves only two parties. This is the main difference, please don't forget. And let us come back to this slide. What is meant by check? Check is unconditional order to pay a certain sum of money. It is drawn by the drawer. It is drawn upon a specified banker, and here three parties are involved, and check should be properly dated, amount should be clear, and it should be signed by the maker or drawer of the check. So, these are the properties of checks, right. So, having learned this, let us look at some nomenclature associated with checks, right. What is order check? A check payable to a particular person or his order, that is order check. Order check is a check payable to a particular person. If I am writing check in the name of K. Tejesh, that means it is order check. Please pay to Tejesh or as specified by him. He can transfer that instrument to some other person by endorsement, that is different. Order check is the check which is payable to a particular person. Bearer check. Bearer check is a check payable to a person whosoever bears. Right? You are not writing the name of the person to whom it is to be paid, then you are giving the check, then it is a bearer check. So, one classic example of a bearer instrument is a currency note. Currency note is bearer instrument, because currency note owner is the person whoever holds that currency note. Here the bearer check is the check payable to a person whosoever bears, that means whosoever presents the check is the bearer check. Order check is it is written in somebody's name. Blank check. Blank check is except signature, other details are not there. That is blank check. Only you have signed on the check and you have given that check to your friend, then that is a blank check. Stale check. Stale check is when the validity is over. At present, the validity of checks and demand drafts is just 3 months. When the validity is over, then that check is called a stale check. Other one is mutilated check. When the check is torn into 2 pieces, that is called a mutilated check. Post dated check. Let us assume today is January 1st and you are taking the check with the date 16th January. Today is January 1st, let us assume, and you are taking the check dated January 16th, that indicates it is post dated check. That means that check will be valid from 16th January onwards only. Open check. When the check is not crossed, that is open check. Crossed means 2 lines and other one is crossed check. Crossed check is the check which carries 2 parallel transverse lines at the corner of the check. So, what is the meaning of crossing? Crossing means that will not go into the fraudulent hands and check will go to genuine person through account payee only. That is the meaning of crossed check. So, these are the items, or you can say these are the words associated with checks, please don't forget. And what is MICR code on checks? MICR code is magnetic ink character recognition. It is a 9-digit code and please don't confuse with IFSC code. IFSC code will have alphanumeric total 11 characters and that is used for RTGS or NEFT purposes, and MICR code is a must on checks. MICR will have only 9 digits. First 3 digits represent city or district. if you take Trivandrum, it is 695. Normally the PIN code will be there for the first 3 digits. Trivandrum 695. Next 3 digits represent the name of the bank and last 3 digits represent branch. And MICR code is a must for check transactions. MICR code is a must for check transactions and IFSC is a must for NEFT and RTGS transactions. Please don't forget. And MICR is magnetic ink character recognition. Please don't forget. And what is meant by material alteration of checks? Material alteration is the alteration which alters the character of the check. That means the operation of the check will be altered, especially alteration of date, alteration of the sum payable, alteration of the name of the payee. If you make some alteration, it indicates that there is some sort of suspicion on the check. That's why important things, these are called material alterations. Please don't forget. And whenever any alteration is there, it requires the full signature of the drawer of the check. Please don't forget. Right friends, look at what is meant by crossing and why crossing is needed. The crossing of the check is just 2 transverse lines, right, over the face of the check. As per the Negotiable Instrument Act, it is written as and co. As per the Negotiable Instrument Act, 2 transverse lines as well as and co was written, but now the present practice is 2 transverse lines and account payee only. Conventionally, if you write account payee only, it is categorized as crossed check. Crossing is 2 types, general crossing, second one is special crossing. General crossing is 2 transverse lines as well as account payee only, and special crossing is crossing for particular bank. If you are making 2 transverse lines and writing SBI only, then it indicates that your check is to be deposited in State Bank of India only. So, special crossing pertains to particular bank. And what is the advantage of crossing, you may ask? Advantage of crossing is payment will be made through the bank account only. When you write account payee only, the payee should deposit the check in his account only. That means there is no chance for any malpractices, right? So, this is about the crossing and the special circumstances where banks can withhold payments. When you are issuing check, and please don't forget, demand draft is certain, but check is not certain. Demand draft payments are certain, no one can stop it, but check payments are not certain, and banks can stop payments under these circumstances. And please don't forget, bank cannot pay when there is no sufficient amount in the account. In the account, when there is no sufficient amount, then they cannot pay. In addition to that, these are the 5 conditions when the bank can stop the payment. First and the foremost is when the death of the drawer occurs. Whoever is issuing check, when his death occurs before the check is presented, then bank can stop the payment. Second is insolvent drawers. X has given the check, but he was already declared as insolvent. Official assignee was nominated by a court. Under those circumstances, he cannot operate his account. Insolvent means he has taken loans from several people and he is not able to pay back. Under those circumstances, court can declare him as insolvent, and when he is declared as insolvent, then official assignee will be nominated by the court and bank account cannot be operated under those circumstances. That means when a person is declared as insolvent, then that account cannot be operated, and when the account holder gives check under those circumstances, it cannot be honored by the bank. Third is when the company is in liquidation. When the company is in liquidation, that means company is not able to run properly and court declared that the company is bankrupt, official liquidator was nominated. Under those circumstances, check cannot be honored. Fourth one is when the customer is insane. Customer is insane means he is mentally not fit. Under those circumstances, if registered medical practitioner proves that the customer is insane, then that check cannot be honored. Countermanding, that means some X has given check and Y is not yet presented. Before that, when X asks bank to stop payment, then that payment cannot be made to Y. That is called countermanding of the payment. So, under these circumstances, check payment can be withheld. Banks cannot pay under these circumstances, right? So, bouncing of checks, all of you are well aware. What is meant by bouncing of check? X has given check to Y. X has given check to Y, but Y could not get the payment from his bank because of the reason sufficient amount is not available in the account of X. X has given check to Y, but he could not get payment because of the reason sufficient amount is not available in the account of X. In those circumstances, that is called dishonor of the check. The name given to it is dishonor of the check. And when the check is dishonored, then ultimately the payee can take to legal recourse. When the check is dishonored, then payee can approach some court, and the procedure is I have listed here. You can go through this procedure. Sections 138 to 142 of Negotiable Instrument Act deals with the cases of bouncing of checks, right? And the procedure I have listed out here, check should be presented within validity. If the check is not presented within the valid period of 3 months, then he cannot claim. Banks cannot honor the checks when it is presented beyond validity, first and foremost thing. And the second thing is, when the check is dishonored, then check return memo will be issued to that person. That means X has given check to Y. If check is dishonored by the bank, then Y will get check return memo. Y will get check return memo. After receiving the check return memo, Y has to write to X demanding payment. He has to write to X within 30 days, and subsequently the drawer of the check, whoever defaulted, can pay within 15 days. Can pay within 15 days. That means one more opportunity is given after bouncing the check. X can pay within 15 days. But if X has not complied with this, if X failed to repay within 15 days, then within 30 days, Y can approach court. I would like to tell you once again, X issued check, Y could not get payment. That means the check got bounced. Subsequently, after getting the check return memo, Y has to write to X within 30 days, and after receiving the letter, X has to pay within 15 days. And if X failed to pay, then Y can go to court within 30 days. Right? So, these are the rules under Negotiable Instrument Act 1881, and subsequently court can impose imprisonment up to 1 year, penalty up to twice the amount, or both. This is as per the Negotiable Instrument Act. You may have a doubt, I am giving mandate to the bank under ECS system instead of checks. Now people are giving mandate under ECS system. When the ECS mandate could not take place due to insufficiency of funds, then the drawer can be taken up under Payments and Settlements Act 2007. When the check bounces, under Negotiable Instrument Act, people can go to court, but when the ECS transaction fails, then under Payments and Settlements Act, he can go to court. This is all about the checks, and look at the difference between demand draft and check. We have already discussed about demand drafts. Demand draft is just akin to bill of exchange, and we discussed in the previous class various features of demand draft. Demand draft is nothing but an order given by a bank to another bank to pay to the payee, that is demand draft. But what are the main differences between check and demand draft? Please look into it. Here the drawer is individual account holder. He may be individual account holder or company, whatever it is. Here the drawer is individual account holder in case of check, but in case of demand draft, normally it is a bank. The second important difference is in check, there is no certainty of payment. The payment is uncertain in case of checks, but in case of demand drafts, the payment is certain. And after receiving the check, payment can be stopped, but demand draft, no one can stop the payment. And the last one is under Negotiable Instrument Act, check is mentioned, but under Negotiable Instrument Act, this demand draft is not mentioned, right? So this is about the differences between check and demand draft. And look at CTS 2010. Now CTS checks are almost evident everywhere. Government first introduced in the National Capital Region these CTS checks, and subsequently almost entire country they are covering now, but still very few percentage of non-CTS checks are in operation. Now the Reserve Bank issued that non-CTS checks should be cleared only once in a week, so as to discourage non-CTS checks. So you can presume that in due course of time, in the entire banking system, these CTS checks will be there. Now 99% of the checks are CTS checks in the banking system. So what are the special features of CTS checks? Please look into this. CTS checks has got several inbuilt features. First and the foremost is security features are here. That means duplicate checks or fraudulent checks are not possible because this has got several security features. The second important aspect is here physically check will not move, only image will move from one place to other place. If someone is presenting check in Bangalore, only image will move, and if the drawer's account or if the account of the maker of the check is Delhi, then only image will go from Bangalore to Delhi, but not the actual check. It will be verified through image process. Physical check will not move. So that is the feature of this CTS check. Let us look at this example. Drawer is in Delhi and his bank is Delhi, and he issued check to his friend in Chennai, and his friend will present check in Chennai, and the branch in Chennai will verify the check electronically or digitally with Delhi. No physical movement of check. No physical movement of check. Only the information contained on the check will be verified electronically from Chennai with Delhi, and subsequently the payment will be made to Y. No physical movement of check. So this is the beauty of CTS checks. Physical movement is eliminated, only the image will be sent. And what are the advantages? It is faster clearing cycle, better reconciliation, better customer service, and these are all the features of CTS checks. The most important two features are frauds can be eliminated because of inbuilt security features. Second important point is faster clearing cycle, because the physical movement of check is eliminated now. From Delhi to Chennai or Chennai to Bangalore, only the image will be verified. Check will not move physically. That is the beauty of this CTS checks, right? So we have learnt about the CTS checks, and in the previous class we learnt about bill of exchange or demand drafts, and we learnt about promissory note, and in this class we learnt in detail about checks and various features of checks, and I hope that you got a clear idea about checks. And with this, let us conclude this lecture, and please join for module 9. We are going to deal with loans and advances in module 9. Have a nice day. Thank you.